Detailed summary of 2025 tax law, what you need to know. The new federal tax law, signed into effect on July 4, 2025, brings a range of changes that impact individuals, businesses, and investors. Tax planning based on this video will save some taxpayers thousands, tens of thousands, or even more tax dollars. Some provisions are modest adjustments, while others introduce new opportunities and planning considerations. In this video, I'll outline the core features of this law as it applies for the tax year 2025. Hi, I'm Dave Horwedel, EA and CEO of Torchlight Tax. If this is too deep a dive for you into taxes, and you would like to simply figure out how to use it to save tax money, you can simply contact Torchlight Tax at 877-758-7797 or info@torchlighttax.com for a free consultation. Income taxes and standard deduction. The federal income tax system continues to use 7 brackets. The marginal rates have mostly remained unchanged, with one exception. The top marginal rate has been reduced from 37% to 36%. All income bracket thresholds have been adjusted for inflation. The standard deduction has also been adjusted to reflect inflation. For 2025, it is $15,000 for single filers, $30,000 for married couples filing jointly, and $22,500 for heads of household. These figures are consistent with expected annual indexing and will continue to adjust in future years. Child tax credit. The child tax credit has been increased to $2,200 per qualifying child under age 17. Up to $1,700 of the credit is refundable. The phase-out threshold has also been raised. It now begins at $400,000 of adjusted gross income for joint filers, providing broader eligibility for middle and upper middle income households. Tip income exclusion. A significant new provision allows workers to exclude up to $25,000 of tip income per year from federal taxable income. This applies to tips that are properly reported to employers and included on W-2 forms. The exclusion phases out for individual taxpayers with income over $150,000 and for married couples earning over $300,000. Tip income remains subject to Social Security and Medicare taxes and may still be taxable at the state level. Overtime pay deduction. Employees who receive overtime pay may deduct up to $12,500 of that income from federal taxable income annually. For married couples filing jointly, the cap is $25,000. The deduction phases out at the same income thresholds as the tip exclusion. Like the tip provision, this affects only federal income tax. Payroll and state taxes continue to apply. Senior deduction. If you're 65 or older, you can now claim an additional deduction of $6,000. Married couples where both spouses are over 65 may deduct $12,000. This deduction is in addition to the standard deduction and phases out beginning at $75,000 of income for individuals and $150,000 for joint filers. Social Security taxation. The calculation for including Social Security benefits in taxable income has been revised. A smaller portion of benefits is now subject to tax for middle-income recipients, while high-income recipients remain subject to tax on up to 85% of benefits. In addition, the income thresholds that determine the taxability of Social Security will now be indexed for inflation beginning in 2026. Qualified business income deduction. The 20% deduction for qualified business income, commonly known as the pass-through deduction or Section 199A, has been made permanent. This applies to eligible income from sole proprietorships, partnerships, limited liability companies, and S corporations. The deduction is still subject to income thresholds and restrictions for specified service trades, but those thresholds will now be indexed for inflation going forward. Depreciation and expensing. Bonus depreciation at 100% has been reinstated and extended through the end of 2027. This allows businesses to fully deduct the cost of qualifying property placed in service during the year. Beginning in 2028, the percentage begins a scheduled phase down, 80% in 2028, 60% in 2029, and so on until it phases out after 2031. This, in conjunction with cost segregation, is probably the best real estate tax savings tool available for 2025. See my videos, What is Bonus Depreciation, an Introduction to Cost Segregation, and related playlists on the Torchlight Tax YouTube channel. Links to these videos are in the description below. Section 179 spending limits have also increased. Businesses may now expense up to $2.5 million of qualifying property annually. These amounts are indexed for inflation. See my video, How Section 179 and bonus depreciation work together. Corporate and international provisions. The corporate income tax rate has been lowered from 21% to a flat 19%, applicable to all C corporations regardless of income level. Some LLCs and S corporations might want to elect C corporation tax status as a result. While S corporations are very good for tax savings and justly popular with small business owners, there are situations where C corporation status might be better. For businesses with international operations, the threshold for including foreign income under the Global Intangible Low-Taxed Income (GILTI) regime has been increased. The deduction for foreign-derived intangible income (FDII) has been extended through 2035. The minimum tax based on financial statement income now applies only to corporations with book income of $2 billion or more. Real estate. The law increases the deferral limit for like-kind exchanges. Section 1031. You may now defer up to $20 million of gain per exchange, with an additional $5 million allowed for long-term residential property. 100% bonus depreciation, as discussed earlier, is an additional tool for massive real estate tax savings used in conjunction with cost segregation. Qualified Opportunity Zones. The Qualified Opportunity Zone program has been extended through 2032. Qualified Opportunity Zones, QOZs, are designated low-income areas across the United States where taxpayers can invest capital gains to spur economic development and, in return, receive significant tax incentives. The key advantages are tax deferral on capital gains reinvested in a Qualified Opportunity Fund, QOF, until as late as 2026. Potential tax-free growth. If the new investment is held for at least 10 years, any appreciation can be permanently excluded from federal capital gains tax. In short, QOZs offer a way to defer, reduce, and even eliminate capital gains taxes for investors willing to put money into long-term projects in economically distressed communities. Internal Revenue Service Administration and Compliance Rules. Beginning in 2026, taxpayers who file more than 5 informational returns, such as Forms W-2 or 1099, will be required to file them electronically. The safe harbor thresholds for avoiding penalties on estimated tax underpayments have been adjusted to align with the new rate structure and standard deduction levels. The Internal Revenue Service has received additional funding, primarily to enhance enforcement among high-income individuals and large corporations. The law directs the agency to limit audit frequency among lower-income filers. This new law introduces targeted adjustments to the tax system, including new deductions for workers, seniors, and families, while preserving the broader rate structure. These provisions are in effect for the 2025 tax year and may influence filing strategies for a wide range of taxpayers. There are a number of changes here, and I advise you to review how these might apply to your 2025 tax bill. There are actions you can take now based on these changes. For example, S corporation owners could have an overtime structure that aligns with maximizing their tax-free overtime. Rideshare drivers could do the same by becoming S corporations, paying themselves on a payroll, and getting their tips and overtime tax-free. Real estate investors could buy a rental property and potentially wipe out their income tax bill for their W-2 and active income using bonus depreciation and cost segregation. If you'd like help navigating these changes or applying them to your own tax situation, contact Torchlight Tax for a free consultation at 877-758-7797 or info@torchlighttax.com. If you found this video helpful, like it, share it, and subscribe to our YouTube channel.